Okay, we are live. All right, Jim, thanks for attending. Everyone, my name is Tom Samuelson. I am the one of the co-founders of Reap AI. For those who haven't met me before, I was an institutional investor active in EM and LATAM for many years, which is how I know Jim. Um, just some housekeeping rules as we start. First, I want to thank our sponsors and partners in Brazil, Sumac, which is a leading investor relations and data provider in Brazil, who was our partner there, and Miranda Partners, a leading corporate advisor and communications provider in Mexico. They do a great job for us, and we're happy to have them along for our ride in AI. So, being an AI company, we want to add some flair to this event. And as you can see in the upper right-hand corner, there is a QR code. For those of you who are watching from a desktop, a laptop, or even iPad, you can use your phone, scan the QR code, which is going to bring you to an event page with an artificial intelligence agent that we set up for Jim and Lucerna with all that data. There you can ask any detailed questions about Lucerna, about Jim's favorite ice cream, only kidding, whatever, get instant answers. Obviously, there's also a comment section here on the right hand. You can put in your questions for Jim there, but if you want to use the AI, it's in the event page. And if you're watching from a mobile device, in the comment section, there is a pinned event URL. You can click that while you're listening to Jim. Again, you can access the Lucerna AI artificial intelligence agent with all of the data. Embedding AI into video stream is a unique event, and we hope that will give our audience a more kind of immersive experience. All right, so let's, without further ado, let's go. Let's talk. I'm going to give a little intro to Jim and then let him take over. So Jim Hayes, he founded Lucerna Global Capital in 2021 and is the CIO and lead portfolio manager. Lucerna manages an EM alternative investment fund as well as a directional EM ex-China fund. Jim, if I make any mistakes, you can correct me later. Jim previously spent almost 14 years at Fidelity, where he was a portfolio manager for the $38 billion Fidelity EM fund, which I believe was a top performer during your tenure there, Jim. Prior to Fidelity, Jim was at Hunter Global and Bauman Capital, two multi-billion-dollar alternative investment funds, both Tiger Clubs, as an analyst. And for all of you IRs in attendance in Latin America, Jim, I believe, worked and lived in both Mexico and for a short time in Brazil. Jim's a graduate of Amherst and has an MBA from the Wharton School. And Jim, I think you're fluent in 5 or 6 languages. Is it 5 or 6?
Yeah, that's right. I have become a language guy over time, but thanks for the kind introduction, and thank you for the invitation. It's great to see you, Tom. I love what you guys are doing.
My pleasure. So again, thank you for coming to chat with us. Especially, we have a really interesting audience, which is a diverse group of IR professionals. So let's start. I've talked too much already. Let's start on the macro view. Give us your helicopter view of the world, and in particular, emerging markets.
Sure. So I'm a bit biased, I suppose. I've been investing in emerging markets for a long time. But my very big picture view is that the U.S. market, in particular, sort of growth U.S. tech and related, are towards the tail end of what has been a very powerful long bull market, and emerging markets are towards the tail end of what has been I think longer than ever historically before, not deeper, but longer than ever historically before bear market. And so I think that, the next, call it 3 to 5 years should look very different for both asset classes. And I think that's an opportunity for those of us that look at emerging markets. There's the top down view in terms of the dollar, in terms of the fact that, the U.S. fiscal situation and policies are more and more emerging market like. But there's really what's more compelling to us is the bottom up view in the context that, across markets like Brazil or Mexico or Indonesia or wherever, we see a quite sizable stable of good businesses that can grow their top lines in the 10 to 15 to 20% range, that have good balance sheets and expanding margins that trade at 9, 10, 11 times earnings. Whereas in the U.S. we see 4% growers at peak margins that are trading at 35 times earnings, and eventually the math just doesn't add up. And so that's one of the facets that gives us increased conviction in our viewpoint.
Great. I know going back, you were one of the first really to go public about your bullish views on some markets that are kind of not on the mainstream, like Argentina, South Africa. And before we get into the big ones, what indicators do you look for from a country perspective? Places like Argentina, so where you identify these opportunities really early, before the mainstream got involved, and even now, a lot of people would be bullish on South Africa, Argentina. So what indicators do you look for?
Yeah, so the first thing I would say is, we're very much stock pickers, not macro investors. So, our bread and butter, we tend to have a focus on what we call the domestic consumption sectors within emerging markets. So that's financials, real estate, internet and telecom, telecom related, consumer, and other things that touch the consumer, whether industrials, utilities, or otherwise. So that's the theme that we're most focused on, and we really, based on our longstanding sector exposure and expertise, that's how we identify our ideas and do our portfolio construction. But with that said, most of us on the call, I suspect, have been doing emerging markets long enough to know that you can't quite divorce the bottom-up process from the macro and the top-down. And so, we do focus on whether it's on a company perspective or for a country, where are things changing or poised to change. And if it's a market like Argentina was, where it had been problematic for a long period of time, and basically had fallen off of people's radars, and the valuations had gotten quite cheap, and it looked like there was a roadmap to change. We thought it was time to sharpen our pencils and take a closer look. We think that's it's a unique moment for Latin America in particular. I think there's a fairly Latin heavy contingent on the call, in that it looks like big chunks of the region might be poised to emulate or follow Argentina and others, and move towards a more business friendly, centrist political environment.
So, as you mentioned, our audience is made up mostly of professionals from Brazil and Mexico. Let's go now into LATAM in general. How do you see things from a geopolitical perspective, and why do you think, let's say, we'll go into specific countries, but why do you think LATAM is poised to grow or to be a good environment for investment?
Yeah, I suppose, part of what I said about emerging markets as a whole applies in a more emphasized fashion for Latin America, in that, emerging markets have lagged developed markets, and depending on your time horizon, but over the fullness of the last 5 to 10 years, Latin America has lagged in particular and gotten quite cheap. And so the type of bottom-up example I gave, where we find a lot of really good companies at cheap valuations with good long-term growth outlooks, that's particularly true in Latin America. So that's the first thing I would say. The second thing I would say is it is a unique moment from that inflection point or political, demographic, policy backdrop, and so we think that's a really interesting aspect here. We can. I'm sure we're going to go into the countries specifically, yeah. And so I'll hold off for some on my more more country specific comments until then. But I think those are the big picture points I'd make from a regional perspective.
Sure. All right, let's dive into it. Mexico first. So there are those who are concerned about the local political environment, and about obviously the Trump administration. When you're looking at Mexico, what gets you excited? Whether it's companies, whether it's macro, like what's your main themes that you're looking at in Mexico?
Yep. So, the Trump and geopolitical and tariff perspective, I know that Mexican tariffs have gone up a bit, but they certainly seem to be on the less affected side of things, not just in the Latin American context, but in a global perspective, global context. And we think that that's intentional and structural, and it will remain the case. So we think that Mexico will be a manufacturing partner increasingly, and take share from markets like China in the years and decades ahead. So that's one of the things that gets us excited. There are some great valuation opportunities and companies that trade cheap, so that gets us excited. I think the thing that gets us most concerned is, frankly, to do more with the domestic politics. Not Sheinbaum per se, the current president, but the fact that Morena has a stranglehold and seems to be, I don't want to throw stones because we've got our own politicians that are maybe overstepping, but the Morena seems to be cementing their power at the local judicial level, et cetera, in ways that make me more uncomfortable than comfortable over the longer term. So that's more my on the concern side of the spectrum for me.
Great. Last but not least, talk about Brazil. So there's a lot of talk, obviously, about the new tariffs that were put on Brazil by the U.S., 50%. We've also got an election looming, which is obviously now come into contention. When you look at Brazil, where do you see opportunities, or how are you sifting through the obviously geopolitics that have just obviously going to dominate the Brazilian theme into the elections?
Yep. So I've been investing in and looking at Brazil for a long period of time, 30 plus years for my sins. And, there's the old phrase that we all know of the country of the future, and it always will be. But I think that, people forget that the last 20 years have been tough. But the last time that Brazil was this cheap was the first time Lula came into power, and people were nervous about what he would do. And from that point, shortly after the election, the Brazilian market went up 700% in dollar terms in 5 years. Now it's kind of trailed down ever since. But the point is, when Brazil does work, it can be pretty powerful. And we think this could be one of those moments. Interest rates are at 15%, and depending on what happens politically in particular, it's poised to fall structurally and quickly over time. Valuations are cheap at 7.5 times forward earnings. Dividend yield for the whole market 7%. It's cheap. There's value there for sure. So that gets us excited. We do think Lula is going to lose the next election, which we think will be a very important positive sort of backdrop. Obviously, our conviction's a bit lower after the last month or two with all the noise that's come from our side, and I think that's been unfortunate. But we still think that the populace at large is ready for change. And Lula barely, the way I think about it is, Lula barely won the first time around against a problematic candidate, and he's done a bad job and has lost popularity since. And so I think if he's got a more centrist, less controversial candidate, which we think is likely, we don't think he's going to win this time around. So maybe again, I could say more on different aspects there, but maybe I'll pause.
Yeah. Definitely. I mean, I don't think we want to go into specific companies to talk about. So the last section we're going to talk about is about really interesting for our attendees, which is the role of investor relations. But before we do that, I just want to remind everyone that you can ask questions of Jim directly here on the comment section. Just put your questions in. You can put them in any language. We can interpret them. Again, also for an immersive experience, there's a QR code you can link to the artificial intelligence, the AI agent for Jim's specific company, Lucerna. So if you again want to pop in questions, you can do that in the AI agent, or specifically for Jim on the comment section here to the right of your screen. All right, so let's roll into the final innings here. So let's discuss the role of investor relations, right? I mean, going back to your days at Fidelity, and your experience now, but obviously you spent a lot of years at Fidelity. You met a lot of people, and give the investor relations professionals in attendance some tips on how they should be, let's say, reaching out. Maybe a lot of them don't have, let's say, don't get invited to all the conferences in the bank, or they go to the conference, they see the same people over and over again. So how should they be reaching out directly to the buy side? And what do you think, let's say, again, from your experience, what do you think the buy side is looking for in terms of best practices from an investor relations perspective? And then I have a follow-up question.
Yeah, sure. So first of all, I think it's a really important role, and I think it does make a difference. Being proactive, being in front of investors, being accessible. I know many of you. It's a pleasure to see you. If I were to provide some thoughts around best practice, or what should be done versus not, I would say, one, be accessible, get in front of people. That usually does involve travel. It doesn't have to, I suppose, but if it's not travel, then be particularly proactive in terms of outreach. I think that it's important to remember that it's not just a sales role, right? You're not there to promote the company and only highlight the positives. You're there to provide information, a balanced view, and build trust so that people trust you on when you present both some of the hurdles and some of the overhangs and issues, as well as the positive case. So that would be something I would say. Another thing I would say, this is a little bit of a personal sandbox or pet peeve or whatever, but I think that guidance is really helpful. And I find that when companies say we don't give guidance, they'll get penalized for it over time, because it just means that people, what does that mean? That means that either they don't have much visibility into their future, and that has implications in terms of what I want to pay for the stock, or they're nervous about it and they don't want to talk about it, and that has implications for what the market might want to pay for the stock. And I think most importantly, what some management teams don't recognize, and it's partly on IR to explain this for those management teams that don't get it, is if you don't give guidance, the street's going to come up with guidance for you, which is likely to be less detailed and based on less close information than what you've got, and they're going to hold you to it. So if you miss their numbers, you're going to get penalized anyway. Wouldn't you rather have your own numbers to get held to as opposed to their numbers? So that would be it's a little bit of a, as I say, a little bit of a side topic, but I would say that. And I guess the final thing I would say to what Tom and the team are doing is, not all investors are the same, and people have different areas of preference or focus or prioritization. And so, it's helpful for you to know what those are. If someone, I happen to be fairly valuation sensitive. So for me, I like to understand what's the valuation based argument for how things could play out over the next several years. There was a contingent of peers at my former employer Fidelity, which is more of a growth shop by nature, that were less valuation sensitive and really wanted to know about TAM and really wanted to know about incentives and management. And so to the degree that you can know those things in advance, going into meetings with different investors, it allows you to make sure you don't speak past each other, make sure that you touch on the topics that matter to them as opposed to just the points that are in your deck. That's a really easy way to lose the audience, is if you don't know what they're looking for and you just talk about the points that you want to talk about, it tends to be a less productive dialogue. And again, I'll pause.
Yeah. Let me ask a question about transparency. I mean, obviously, I think a lot of companies, I'm just going to companies in general, sort of check boxes and just, put out this, put out that. But like, what's your feeling on transparency and how open a company should be, and how much information they should be disclosing?
Yeah, I think that my broad viewpoint around that, it speaks to the way I was talking about guidance. But I think it is, to your question, it is a broader point. There's more to transparency than just guidance. I think to the degree you can, and I understand why there are instances when you shouldn't or when you can't, from a competitive or regulatory or otherwise perspective. Right? I mean, there are some things that should be kept low key or kept non-disclosed, of course. But to the degree that you can, I think that people appreciate it, and I think that people reward you for it in terms of trust and in terms of the multiple that over time they're willing to apply to your stock.
One of the things that I guess people in investor relations don't understand is the role of compliance. And I know that compliance, whether you're at a shop like yours, which is you founded it 3 years ago at your own place, or you worked at Fidelity. Can you talk about compliance and communications and that type of thing? What you're limited and what you can and cannot do from a communication standpoint, or just in general, so they can understand what compliance really means for financial participants.
Sure. So, obviously it's an important topic on both sides, on the IR side and the company side, as well as the investor side. And so obviously, I think this won't apply to the people on the call. I mean, you need to know what the rules are, right? And then you need to comply with them. And again, not just for your own sake, but for the sake of the investors you're speaking with that don't want to be wall crossed inadvertently, for example. So I think, I don't know that I have a lot to say, which isn't hopefully obvious, but it's just that it's, we're all in this together in terms of making sure that we stay on the right side of any gray areas.
And just a follow-up question to that. Today, really, we're limited when we communicate outside the country to things like email today, right? Something about compliance portals, and email has become very crowded. It's obviously the number one distribution. Everyone sends out emails. I mean, back in Fidelity, how many emails did you get a day? I used to get a lot, but how many emails would someone like you get per day from a global perspective? And is email effective anymore from a communication?
I did count at one point because I was curious, morbidly curious maybe, but no, for a good while there, I was getting 2,000 emails a day. And I think at this point I'm getting probably still too many. I still probably get 500 or 600, which is, I think, more manageable, but still probably too high. No, I think this goes back to the targeted point. Like if you're sending out one, email per quarter or even month, which is basically this is our update, and you send the same email to everybody, you're probably not doing it optimally. In other words, what you want to do is have a sense for who's looking for what again. And so some people want to have, a call once a year, and some people want to have a call once a week, which is too much. You can't do that, but they have different things that they're focused on. So you should, to the degree that you can have differentiated distribution lists, or it doesn't have to be email, it can be various ways of communicating with them, that you can match their preferences for what they're looking for. I think that only helps build relationships and dialogue over time.
Yeah, it's I was that number is larger than I thought. 2,000 emails a day. I used to get a lot. I think back it was like 500 or 600, and I would spend just all my time deleting email. So email isn't the bottom line is email is not effective anymore. All right. I obviously, being in the AI game, I would obviously I have to ask this question. So talking about AI, talking about let's say your uses of AI, and how do you think as AI becomes, we're really in the early days, but as the AI implementation really starts to take off, which I think it's beginning now, in terms of information gathering, investment decisions, is AI play a role for you today? And I know it will in the future. So how do you see things now, and how do you see things changing in the future with artificial intelligence?
Yeah, so I think I agree with your big picture premise that A, it's early days, and B, this is important and will change most jobs, including our jobs on both sides, the investor side and the investor relations side. We have started using it. You need to keep in mind, I think many of you know this, but maybe you don't all, that there are a lot of, especially big places, where people are not allowed to use it because it hasn't made its way through the comfort zone of compliance departments in particular, right? I think JP Morgan might be even one. There's some really big places that don't allow their employees to use AI while they're at work. So that's worth knowing. That I think will change over time. We're not in that bucket. We can use it, and what we use it for is probably most frequently transcripts. We might ask AI to parse through a transcript with a focus on 2 or 3 particular points that are of interest to us on that sector or stock. But we have started to just toy around with asking questions like, is this a good stock? What are the best positioned stocks or companies in this sector? That type of thing, just to see what it comes up with. I'm not going to say that what it comes up with is actionable at this point, usually, but it sometimes provides different perspective or makes some points that we hadn't thought about that helps us do our work, helps us dig in on the research side.
Before we wrap things up, if there are any questions from the audience, please use the comment section, or I'll just keep monopolizing Jim's time. But just a couple final more things, just on the how about going from a place like Fidelity, which obviously every company in the world wants to speak with you, You get every broker is like bending over backwards to give you meetings. You get invited to 50 conferences a year. You get to sit in the room. The companies come to you. I was one of the schlubs who had to walk from hotel room to hotel room. You get to sit in one room and people come to you. And then going from that experience for decade and a half to where now you have your own firm. You're obviously smaller. You're not managing 38 billion anymore. So like, how's that transition been?
Yeah, we were managing 38 billion, which was big from an EM perspective. But I was amazed to read the other day that Fidelity's just crossed 6 trillion in assets, which is I think larger than the GDP of all but a small handful of countries, which was amazing to me. First thing I would say is we've been very pleasantly surprised with the degree. So it's primarily from an investment portfolio manager perspective. It's myself and Brent Bottomini, who was also at Fidelity for around 14 years. He had a handful of roles there, but one of them was managing the Latin America fund. This was back a bit. So this is before Will Pruitt and Adam Kutas. We've been pleasantly surprised with the degree of access we've gotten. So we're grateful to those on this call that have been helpful in that regard. We're grateful to our friends on the street that have been helpful in that regard. So that's been a nice surprise. The other thing I would say is for us, part of why we did this is we didn't think a $38 billion fund that had to be fully invested at all times, and really because of its size, could only be invested in mega caps, and there was a certain degree, quite large degree potentially, of friction getting in and out of positions, et cetera. We didn't necessarily think that was the best mousetrap, the best vehicle for investing in emerging markets. So what we do now is much more concentrated. We typically have, depends on our strategy or vehicle, a couple different strategies. But we typically have 20 to 30 names alongside, and then we have some long short vehicles where we might have a similar number of names on the short side. And what we're looking for is something very specific within our domestic sector focus, our domestic consumption thematic focus. We're looking for good companies, often at a displaced valuation because of some misperception in the market, where we think that misperception has already begun to, or is soon poised to begun to repair in such a way that we can see upward estimate revisions, multiple expansion, and basically a virtuous cycle. And so what that means is, typically there only are a couple handfuls of those at any given points in time. We don't have to cover every stock, every large cap, the way that some of the large firms feel like they need to do things. I guess the point of all of that is to say, in general, we've had great access. And then with regards to those situations which fit our sweet spot and our focus, we've also been able to get good access. And so we're grateful to all involved for that.
Awesome. Okay, we have a question from the audience. Here we go. How does the political environment impact your analysis of a company, and to what extent do you delve into and monitor this topic? And then the second part is, what should an IR professional communicate and make clear to investors when the electoral environment could impact the stock's value? Interesting.
Yeah, it is a good question, and it's a complicated question. Look, I think it depends on the point in time and the country, frankly. So Mexico, I talked about the fact that we like the economic ties to some larger markets. We like the bottom up and the companies, and that's really where we spend our time. We do have some longer term concerns about some of the political trends there, but they're longer term concerns, and they're not something we spend a ton of time talking or thinking about. Whereas Brazil, and I'm going to potentially overstate this for effect, but only slightly. Brazil is binary. We happen to think Lula is going to lose and that the market's going to triple over 2 years. But if we're wrong and Lula wins, Brazil becomes all but uninvestable, because people are done with the PT in terms of I think the local investment community and the foreign investment community. And even if they came in with a better team and tried to do some of the right things, people are just not going to give them the benefit of the doubt, which means we're in a vicious cycle where rates stay high or go higher, currency gets weaker, inflation stays elevated, fiscal becomes an issue, things that we're all familiar with. And so therefore, since it's so important in Brazil, we end up having a bigger portion of the conversations around recent political changes, polls, et cetera, in that market. So I guess the short answer is it depends, and those are some examples of why and how it can depend.
Yeah. No. Look, I think that you and I have been around long enough to know that sometimes when you could have a great company, but if it's in a really bad neighborhood, it just doesn't matter what happens, right?
Yep.
Well, I think we've reached our limit on questions. Jim, listen, man, I want to, again, from the audience and myself, I want to thank you very much for taking your time to speak with the investor relations community in Latin America. I think it's important for them to hear from people like yourself. We have a question here, but again, I think it's really important that IR professionals hear from people like you about their views and also about best practice. So we have another question just came in. Which do you think is the main thing that most Mexican investor relation people forget to highlight or to sell about Mexico? The points where we are actually more pessimistic than the foreign view. Well, that's interesting, where obviously Mexican locals seem to be more pessimistic. But again, what do you think the Mexican investor relations community should, what are they forgetting to highlight or sell about Mexico? Because maybe they have a bias, more negative than you. I hope I interpret that question.
Yeah, no, I understand the question, and it's a good question as well. I don't know that I would say that there's a commonality around, Mexican management or IR teams I talk with where there's something that which is missed as a rule. I guess what I would say is, if I were in that seat, right, if I were talking about Mexico and the advantages, I would talk about obviously the proximity to the U.S. and the increasingly integrated manufacturing and distribution chains. Obviously, there's a labor gap. Mexico is a younger demographic, so that labor gap, the wage gap, I should say, and so that's likely to persist and be a continually positive arbitrage or opportunity. There's some industries where Mexico is particularly strong, or where companies are well positioned. So I think that it's a market where this is good and bad, you could argue, but it's a market where it's a country with a decent degree of sector concentration in most sectors, which tends to lead to structurally higher profits. So I do think that's something that's underemphasized. The fact that industry structure tends to be fairly concentrated in such a way that it tends to be a market with high structural ROE and profitability. And then from there, it ends up being company and sector specific. The only other broader point I would make, and this is not for Mexican IR teams specifically or even Latin, this is, I think, a more global comment, but I suspect most of the people on the call do this well. It's important to know the 2 or 3 things that really matter for your stock. What investors care about. One of my pet peeves, I talked about guidance. The other pet peeve I might talk about is when you come in and talk to a management team or an IR team that says, "Yeah, things are going great. We're tracking ahead. We feel great about this product or this trend or this market or whatever." And then the numbers come out and the stock sells down 10% because they didn't in their own minds focus on the fact that it's not the top line that people are looking at. It's the margins of the free cash flow, and those miss dramatically, right? It's a little bit of a hypothetical, silly example, but my point is, don't play up the revenues and talk about the revenues if that's not what matters for the stock. If everyone's focused on free cash flow and that's where the hurdles are, be candid about it to the degree that you can. So I'm going off on a tangent. I'm sorry, Tom,
right.
But you put me on my another topic.
There's another question from the event page, and I guess I think you answered the first part of it. Just have the second part, and I think this could be relevant to other people. So how can companies, or how can investor relation professionals from smaller cap emerging market companies with fewer resources compete with some? I mean, there are some. I'm not going to mention the company. There are some companies in Brazil that have 20 plus people. So how can a smaller or mid cap company with 1 or 2 IR professionals, how with obviously less resources, how can they make a difference for someone like yourself or a fund manager?
Well, the part of the reason I wanted to explain what we're looking for is, in case there are those on the call that feel that they qualify for what I described, right? A good business with a strong long-term growth outlook that's trading at a displaced valuation, which is based on a misperception, right? So if anyone happens to be on the call and feels like you fit within those, please reach out to us through Tom or otherwise. We're not hard to find, but the point of me reiterating that is not self-interested or not meant to be self-interested as much as to give an example. Like if you're a small or medium-sized company, not everyone's going to care, right? Someone that runs example of that $38 billion fund at a really big shop probably won't be able to do much with your stock, and it's going to be hard to get a meeting with them. And you can send emails, but it's not likely to be productive. But there is a group of EM, let's say value investors or mid-sized shops or mid-sized, mid-cap investors or whatever it is, that will care. And so what you want to do over time, to the degree possible, including through services like what Tom and team are offering, is identify which those groups are, what they care about, and then reach out in a format that speaks to those interests. And I think that if you do that, it can lead to it can be much more productive in terms of your time. It can be much more productive in terms of the hit rate on calls and meetings, and ultimately on people investing.
Okay, another question here. I think you might have answered this, but it says, are you currently more bullish or bearish on Brazil? Again, given your view that the country's polarized. Additionally, are there any sectors where you believe the political environment has little impact on investors, considering they need to allocate part of their investments to Latin America anyway? So deal with that as you may.
Well, I think it may have come in after I'd given part of my spiel on Brazil, or maybe not. But we happen to be quite bullish in Brazil, and we have a sizable overweight. But it's because, in this case, it's because of the fact that we do see some really good companies that trade at really good valuations, or really compelling valuations. But it's because we also think that the PT has had its time in the sun. If we're wrong about that, we're going to have to reassess, and quickly. But that's our perspective. Are there companies in Brazil that are going to be more or less insulated? Yeah, sort of. I mean, yes, right. There are companies that have FX exposure, or good balance sheets, or whatever. But if we're right that Lula wins, everything's going to go up, and quite a lot. If we're wrong, and rather, if we're right and Lula loses, everything's going to go up and quite a lot. If we're wrong and Lula wins, you may go down less, but it's going to be a hard window.
Yeah, and I guess what I think there's an example of that. So, like, say in the 2012-13 to the 2015 period, you had Lula, Dilma in power. I mean, I think that was probably a real dark time in Brazil during that period. So when you were at Fidelity, how did you look at Brazil? I mean, you guys obviously had to have investments here, but how did you look at Brazil during that dark period when people were kind of saying it's over?
It's a good question. I think from a Fidelity perspective, or from the perspective of what I was doing and looking at, it tended to mean higher quality. It tended to mean larger cap. It tended to mean fewer positions and less exposure. But yes, we did maintain investments at that point. It was a different vehicle and model than what we have now. But yes, you're right. We did maintain investments. We had an underweight or a smaller position vis-a-vis what we have in environments where we're more constructive, and it would be more up the quality scale and more up the market cap scale.
Cool.
Good balance sheets, high ROE, et cetera.
All right. Well, listen, Jim, thanks for 40 minutes. Thank you so much. And I think from our audience, they really appreciate your views and understanding things, not just on the views of emerging markets in Latin America, but also views on how investor relations people can allocate their time and use best practices to get to target investors and get better at their job. So again, for everyone, thanks again. And we really appreciate you. There'll be a replay here, which again, and also the QR code will stay if you want to fool around with the AI and ask questions about Jim's Fund. But again, thanks everyone.
Thanks all. Thanks for the invitation.